Ken Shinoda joins us right now, portfolio manager over at DoubleLine Capital. And a little bit earlier, before the Fed meeting, Ken, we had a chance to catch up with Bob Michael over at JP Morgan Investment and Management. And I thought it was kind of interesting. His reaction to this report was basically, in his words, it was not as much as the market expected, but not as bad as the market feared. What did you make of today's decision?
Yeah, I think the market expected more of a hawkish cut. That's why the Treasury curve had been selling off for the last couple of days. I know we're rallying today. We're basically back to where we were at the beginning of last week. I kind of view it as a pretty balanced Fed with maybe a dovish tilt. And I think one of the things that led to that bond market rally was the announcement of Treasury purchases, T-bill purchases. We joked on the desk here that we're doing quasi-QE again.
Well, that's what I'm curious about. I mean, let's just point out, he avoided calling it QE, but is that effectively what it is? And I guess more importantly, Ken, why do you think they felt the need to do this now? I know there had been some pressure coming out of the folks in the Treasury market saying that the Fed needed to step back in. Was that the reason?
Well, I think you're seeing a little bit of lack of liquidity in the repo markets, and they want to, going into year end, they want to keep that liquidity high. So I think it's really to kind of support those repo markets and balance sheet liquidity out there.
And let's talk a little bit about the bond market reaction, because, again, you see that over the past couple of weeks, there's been this rise in the long end, and there's been some concern about what that means. You're seeing 10-year yields in particular come in a little bit today. I wonder how you're thinking about some of the movements on the curve and whether the respite maybe that we're seeing is something that's going to be sustainable.
Well, we've been trading range bound, and 4% on the lower bound has kind of been a sticky spot. It's been hard to break through, and I don't think the bond market can break through that 4% without considerable weakness in the labor market. And I know the Fed's definitely concerned about that. They mentioned it a couple times, and I think it's the labor market data that has led them to their cut today. One thing that Powell noted is that the payroll numbers have been coming in around 40,000, and they actually think they're overstated by about 60,000, which means we had negative payrolls. And I think that's a main reason they cut. Now, the other thing the market's concerned about, and it comes and goes, is fiscal concerns about too much spending and the interest costs on outstanding debt that continues to rise. So I think there's this push and pull between weakness in the labor market helping long-term rates fall, and then concerns that deficits are already high and we're not even in a recession. So if we go into a recession, I'm not saying that's my base case, that would mean even more spending has to come. So this is the push and pull that the long end of the yield curve has to deal with right now.
Absolutely, and the result, as you mentioned, has been sort of a range-bound trading environment. But let's take a look into next year, because I thought it was interesting to hear the chairman say that this further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend towards 2%. That could be setting up a pause here when you think about both sides of the dual mandate and the threading that they need to do. How did you read that comment? And if we are headed to a Fed pause, which may extend at least until May 2026, what does that mean for you in your seat as a portfolio manager?
I definitely think it's possible. He mentioned many times that we're in a good place. I think he said we're in a good place 5-6 times, which means that he feels that they're at a good spots. And I think short-term rates have now come down to where the 2-year is. The 2-year had come down much more than policy rates, and we're now pretty close to the 3% neutral rate that many market participants believe is where we should get to. So I think with inflation kind of remaining sticky at that 3%, that gives them the potential to stay on hold and wait for data. And so they're really going to be relying on that labor information come through.
When you look at longer-term yields, though, Ken, I mean, do you get a sense here that we will see a more meaningful resumption of the steepening of the yield curve, not so much just because of what the Fed is doing, but obviously with a lot of the other noise going on in the background, whether it's the deluge of corporate issuance on the AI side, the increase in the term premium, et cetera?
I think all those things are part of it, and also what's going on internationally. I think one of the reasons we saw this recent move was they're starting to talk about rate hikes over in Europe. And in Japan, that could continue to happen too. So, in other parts of the globe, you're seeing inflation kind of pick back up. So if you're starting to see hikes over in Europe, it's going to be hard for the long end to rally.
All right, Ken, always appreciate the quick and instant analysis coming out of these Fed meetings. Ken Shinoda, portfolio manager over at DoubleLine Capital.